Good morning, good afternoon, good evening. Welcome to another episode of Playbook of the Wealthy. My name is Dave Grant. My co-host, the fidget herself, is Heather Townsend. She's with me. She's ready after a little bit to record. You are joining us today for a mammoth episode where we discuss Trump's big, beautiful bill. We're going to focus on the high income earners and business owners today. We'll discuss retirees in another episode. If you've never been here before, if this is the first episode you're tuning in for, if you could leave us a like, comment, if you could subscribe if you like it that much, if you could put it in the boys and girls chat, if you could follow the podcast, if you could do anything you can to give us some extra reach, that'd be wonderful. If you've been here before, thank you for your likes, comments, subscribes, follows, sending it to your mom. Also, if you think that someone should benefit from learning about this tax bill, you definitely need to send it to them. And by anyone, I mean everyone, because everyone has questions. So thank you. Jordan's going to do the disclaimers at the end, so I know some of you just tune in for him. You're going to have to wait. So our podcast is split into 4 sections. You get to know us professionally, personally. We dive into content, and then we answer some questions. So our first segment, it's all about us professionally. Heather, how are you doing?
I'm good. I'm much better today, but I will tell you last week I was exhausted. Studying this bill, I mean, we're going to go into it. It's just massive. I think this is bigger than the Tax Cuts and Jobs Act. It might be a little bit better because it's extending it, but it is the amount of changes in this bill is just, I had to leave stuff out. I was like, does this apply to most people? If not including it.
And I love how some of it is all encompassing for a lot of people, and some of it is like a tiny little segment that they've tweaked or changed the date. And it's like, sure.
Yeah. Otherwise, good. Catching up. Finally feeling like I'm getting that summer. It took me to the middle of July to finally feel like, oh, am I about to have a moment of fresh air to like catch up on business stuff? Like I ran payroll for myself today. Hi, I'm so excited.
Been a busy one, huh?
Yeah, it's just a little bit.
Yep. Not like that over here. It's still busy with client stuff, but it's the case of, well, working at home has its own complex strategies of, my wife is on her summer break, so she wants to get stuff done. Kids need carting around here, there, and everywhere. I try and work in the middle of it while trying to have some downtime. It's just a hodgepodge of life.
I was literally talking to my nanny, and I lead with gratitude a lot of points in my life, but I am so grateful that I have the resources to pay for childcare during the summer. But for families that don't, I mean, it's hard being working parents and having kids home in the summer. That is no joke. Mm-hmm. It is no joke.
Yeah. Sarah's usually been off for the whole of the kids' summer break. And now she's transitioning to be an assistant principal. She's going to get 1 month off in the summer, and like June and August. That's kind of on me now. But it helps having older kids. Next year, Eli will be 16, Logan will be 13, almost 14. So that's easier. But it's still a juggle. I definitely agree with you.
Yeah. All right, let's get into this. Can we dive in? Everyone, I'm going to forewarn you right now. Dave has a new toy, and he found the sound effects in our podcast software. So everyone, I'm sorry. I apologize in advance.
Yep. They're coming thick and fast. Don't you worry. I mean, we got to do something to get through this tax bill. All right.
Come on, we're going to make it interesting. I am going to give you my opinions, everyone. So just brace yourself, and planning tips. So
what? You give an opinion? Come on.
No way.
Do that.
No way. No, I'm going to make some jokes for sure. They're coming. All right. I first want to start off to our listeners and say, massive bill. I can't say that enough. That is literally the only word. I can keep saying massive. Also, what I want to say is on some of these topics in the CPA community, we are waiting for regs and guidance. There are some things, and Dave and I will state, we need more guidance on this, whatnot. But I know taxes is kind of a little, not the most exciting thing to talk about, but I'm going to get you excited because guess what your biggest expense is in your household? Dave, what is it?
Dude wipes.
What are those?
Oh, come on.
No, I really don't know what those are. What, dude wipes? What the fluff are those?
They're like baby wipes for adults. Anyway, that was off
Okay.
topic. The biggest expense in a household is taxes.
Is taxes. And so, if we can give you a little bit of a raise or cut that expense a little bit, you should want to listen and get ready so that you can go to your tax preparers or know what to take advantage of here. Right, Dave?
Mm-hmm. And there are some topics we are going to gloss over because there's some things that are important, but we don't need to go into detail. And then there's some that are important that will have ramifications for a lot of listeners that we will go into detail on.
I'm going to start off with the easy ones. Tax rates, brackets stay the same. What tax brackets have been, they're staying. They're now permanent. The Tax Cuts and Jobs Act in Trump's first presidency, those brackets are staying exactly as they are. No changes. Tips and overtime. This is also one of those things we're going to gloss over because Dave and I don't have a lot of clients, at least I don't, that are receiving tips or overtime. Mm-hmm. No. But I told you I was going to give you a little joke and some opinions. I think this is completely, as the person I take a lot of my tax education from, he's been in practice for 40, 50 years in taxes. And he goes, I think this is wildly overblown. And I couldn't agree more. Okay, let's say you're a server and you haven't been reporting tips. And now all of a sudden you're going to report for the next 4 years, because it expires in 2028, that you have $30,000 in tips on your W-2 so that you're not taxed on them. Then in 2029, when you don't get the deduction anymore, you can't not report that you're making 0 tips. Like, this is, I think, a way that you're going to have, that they're trying to get tips reported.
It's extra revenue for the Treasury here. Mm-hmm. No one's escaping it.
Yeah.
And it's almost like we'll give you this little break for the next 3 years and then bam, 2029, nothing. And we want all your income and your taxes reported. Come on.
Mm-hmm. Yeah. Okay. You get to talk about this one because Dave, you've just taken advantage of this one. So why don't you share?
Oh, I'm not going to blow the lead there in terms of telling my story, but EV credits are disappearing. So if you are looking to buy an electronic car or a car that is eligible for an EV credit, you have to do so before September 30th, 2025. That is not long. So you have to take delivery of the car by that point as well. So if you're ordering one September 20th and you can't get it until October, you don't get the credit.
Great example.
There's also other credits. They're home credits. They expire too, but on wildly different dates, depending on what you're going to do. So if you're going to get solar power, do so by the end of the year. If you're going to get energy efficient windows, doors, water heaters, do that by the end of the year. If you're going to get an EV charger, take your time. You don't have to stress about it. June of 2026, because that's what takes the most time to put in your house.
Also, speaking of cars, this new auto loan interest deduction. I don't think many of our clients are going to take advantage of this, but because the income thresholds are kind of low. But if you get to deduct up to $10,000 a year in car loan interest, the income limit is $100,000 single, $200,000 joint. So if you make over that, you're going to start phasing out and probably not get the deduction. If you are
don't forget the huge caveat. What? It has to come off a U.S. assembly line.
Yes, it does. And you have to provide the VIN.
Yeah. If you're getting a Japanese car that's getting shipped over here, nope.
No, of course not. This is one of those that I believe is 2025 through 2028. So planning here is if you're buying a car, I would buy this car that if you're going to be paying interest on in 2025 or 2026, right? So you get multiple years to deduct, because if you buy it in 2028, you only get to deduct the interest for 2028. It expires then. So, EV before 930, if you're getting a car loan and you're in those income ranges, you want to do it in the next 1 or 2 years. So you have a few years you can deduct that interest. All right, mortgage interest. I'm not going to go into too much here. The only interesting thing is mortgage insurance. So that's when you put down less than 20% on a home loan, you normally then mortgage insurance comes in. This is now again going to be deductible starting in 2026. What I am waiting guidance on is there an income limitation on this? You want to go next? You take the next one. I've just talked a lot.
HSAs? I don't know much about HSAs because I only use a few of them with clients. You love HSAs. It's like your third child.
It is. Oh, I could talk about them. I think they're better than Roth IRAs.
All right. So you do HSAs. I'll do the next one.
Just that, one thing that I was sad about is they were talking about in the bill of expanding the maximum contribution limits. That did not happen. What they did do is they expanded on what plans will be eligible for HSAs to bronze and catastrophic ACA plans starting in 2026. So really on HSAs, to keep this simple, is more health insurance plans are going to make it eligible to have an HSA connected to it.
Okay, moving on. Student loans. This is actually something that blew up in our town Facebook group as people who were freaking out because their kids were going to college and now all the rules are changing.
Mm-hmm.
So you're going to have to plan a little bit more in detail about how you're going to fund college now. Student loans, you're going to have some loan limits coming in starting July 2026. Mainly for graduate and professional loans, they're going to have a lifetime limit as well as an annual limit. And then when you come to pay them back, there's only going to be 2 payment plans. There's been numerous revisions and numerous additions to payment plans. Now you can have a standard payment plan, essentially looks like a mortgage, or you're going to have an income-based repayment plan, which then looks at what your income is and then calculates your payment. For this, I'm going to suggest you should be looking again at how you are funding your child's college if you're planning to do loans. Because if you're looking to get, let's say you're upper middle class, you're not going to get much with FAFSA, but you haven't saved a lot and you're relying on loans. You may need to take out some of your high-cost college options because even though your child may get in there, you may not be able to pay for it all with loans. You're going to cap out.
I have
so
a
you
question
may need to revise
for you.
this.
I haven't studied this as much as you have on the caps yet, but I thought about this and I'm like, does this mean, did we just make it harder for people in lower income, people that don't have the parental means to donate to or to contribute to 529s and have these sizable 529s for their kids' college? Did we just basically make certain schools now only going to be for high income or certain professions be for high income, high net worth families like doctors? I mean, if there's limits on graduate loans, I mean, how expensive is medical school? Like, again, haven't done a lot of research in this, but just hearing you right now, it's a question that is triggering my head right now. I'm like, what have we just done? Now, do I think that people should be coming out of school with these wildly huge loans? Of course not. I don't like to see this. I have some clients in that situation with hundreds of thousands of dollars of loans, but it does worry me a little bit of, have we just said, hey, unless you can get some really good scholarship or you come from a well-to-do family that can pay for these expensive schools or expensive education, have we just completely segmented the population? Is this a ridiculous question?
No, it's a good question because I think if you are lower income, you're going to score favorably on FAFSA because your income's lower. So your college cost is going to be lower just based on that. If you are high net worth, high income, you're going to be paying for this out of pocket or you've already saved. Doesn't really affect you. This really hits the person transitioning from middle income to high income right before their kid goes to college, because then you file FAFSA, you get nothing on your EFC. And so you're expected to pay full cost, but you also haven't been able to save because you're just coming out of a middle income. So that's the person who's going to hit more. So you just have to be more deliberate on what's happening for school. So if you're planning on your child becoming a doctor and you finance this all the way through, well, they could still become a doctor, but your route is going to be different. It may take them a little longer. They may have to be picking up jobs the whole way through versus relying on loans and paying them off when they get that doctor salary. So maybe it's going to be a little different with who can get jobs by going through expensive schools. It's just going to require a little bit different thinking.
And I wonder how schools are going to react to this, the expensive schools. It's going to be interesting how this carries out over time and how colleges react. I'm very curious.
There was one good comment in the Facebook group of, okay, now we've capped loans. Can we cap tuition?
Yes. I mean, seriously though, like seriously. Yeah. Okay. The other thing on student loans though, I think this is huge. So the SAVE plan that came out under Biden's presidency, this was where, what the administration was trying to accomplish was that basically your interest couldn't accrue more than your payment. So you weren't adding additional accrued interest. There was an interest subsidy. And now that SAVE plan, many people that had selected the SAVE plan, because for many student loan borrowers, that was the best income driven repayment plan to be on.
Mm-hmm.
So because it was in these lawsuits for the last, year or so, many borrowers were on forbearance. And then you count in COVID forbearance. People haven't really even had to I don't think many people have even had to resubmit their income in a very long time. This is going to get extremely interesting because the SAVE plan is going away as of August 1st, and you have to pick a new income-driven repayment plan. I wonder if they're going to ask for your latest tax return and, recertify your income.
Mm-hmm.
While these tariffs are being hit, I'm hearing inflation is hitting again. And now you're going to bring back these student loan payments for a lot of borrowers. Interesting time. What I would say to borrowers that are listening is please pay attention to any information from your student loan servicer because changes are happening. And from what I've read, for most people, IBR is going to be most likely your best payment option. Unless if you have extremely high income, then you might just want to be on the standard repayment and you probably wouldn't even qualify for forgiveness anyways. But this is where you really got to pay attention and do some student loan planning. You got to start paying attention to your student loans again, for sure.
We are going into free money from the government, from Mr. Trump, President Trump, giving all your children a gift when they're born. The Trump savings account.
Oh, dear. Oh, this one. This is another one that I think is kind of overblown. I mean, and this is what I would pay attention to, listeners. If you have a child born, what are the dates, Dave? Would now
2025, retroactive to the start of 2025 through the end of 2028.
Okay. So I have some friends that I think are going to have some kids born in this time, some clients too. So You get the $1,000 from the government. Great. That's free. Definitely take advantage of it. You're going to invest it in some index funds. Great. Okay. You can't contribute to this thing until July 2026. I'm not really changing anything because what I think is I want to know exactly what a qualified withdrawal is on these things, what they count it as, and how it's taxed. Some people are saying capital gain rates. Some people are saying IRA rates. We need guidance here. Until I know how it's taxed and what it can be taken out for, I'm not very excited about it. The only part that I'm excited about that I did want to say that I find very interesting is that employers can also contribute up to $2,500 annually for an employee's eligible child without it being considered taxable income for the employee. So that's like a $2,500 free gift to your employee's child. That's interesting. If it's going to be tax deductible to the employer, I'm going to pay attention to that. But that's what's interesting. These contributions so you can only put $5,000 away a year starting next year. Parents, relatives, they can all do it. But I think a child can only receive $5,000 per year until they're 18, but it's not tax deductible.
Right. I mean, let's play this out. While you've got all these different avenues of savings, 529, Roth, UTMAs, let's play this out for someone who has a lot of excess cash flow. So they have a baby, 2025. They can throw $5,000 a year into this. They're also a business owner. They can throw $2,500 into this. So you're throwing $7,500 into this account that just magically appeared for you because you had a child. So you do that all the way up until your child's 18. Then they can start to take it out for those qualified expenses, which is starting a business, going to school, buying a house, as we know of right now. But you have now found another way to divert all of that income that you had in a tax-deferred savings vehicle that's now for your child. If you can fund your child's education through other means, they don't have to touch this account, and you tell them, leave this alone. They now have roughly $300,000 by the time they're 18 that they can leave alone. That's millions if they are leaving it alone until retirement. And all you had to do was $5,000 to $7,500 while they were born.
And let's just talk about the wealthy problems here, right? It's like a way funnel more income to your kids now, like, to get under that estate exemption. So whenever you pass. So yes, income wealth coming out of your ears, I'm paying attention to. But in order of priority, 529 for education still.
Yes.
Roth IRAs for kids still. Here's the interesting part. Then if you still have money left over, then you do this, because this doesn't hurt IRA contribution levels, which I thought was interesting. Like this, everyone's calling it the Trump IRA, but it's not really an IRA because it doesn't mess with the IRA contribution maxes, the limits.
The interesting thing to see is how this is qualified on FAFSA. Like this is a child asset, but it's available for school. Yes. So does that mean it's now the version of a child UTMR account, which is adversely calculated with FAFSA? It's a higher percentage that goes into the calculation. So that's something that we don't know yet. But we'll definitely determine if people are starting to save into it or not.
Ooh, 529 changes though, why we're still on this topic. So this came out a while ago. I think it was the Tax Cuts and Jobs Act where you could pull, I don't remember which tax law. There's been so many now, changes in the last, 5-7 years. But you can now use $10,000 for, kindergarten through 12 of 529 funds, $10,000 a year. They just increased it to 20,000. And I find that I think that's pretty great if you have a kid going to private school right now. Like, get that money in the 529. And then I also love this. They increase kind of what is eligible as education expenses to include credential apprenticeship programs. You can help me with that word, and tutoring. And I think that's great. Now we're getting into
just now we're getting into the meat.
The meat. Okay. We're going to go over high income problems. And let's just say we're going to count high income at 400, 500? That's what I
think a lot of these things kick in at 500.
Yeah. So you're making 500 and above, you need to start paying attention. Itemized deductions. You are going to start getting a reduction for how much you can subtract through itemized deductions on your tax return if you hit the 37% tax bracket. Let's just go fast forward now to AMT. If you are over 500,000 single, 1 million joint, AMT is coming into your world. And what AMT means is you basically can't deduct as many things. It is the way that the IRS it's like a separate tax calculation, and it is making sure you're going to pay your fair amount of tax. It is a completely different taxation, and you are going to have to pay the higher rate.
Yeah, AMT is like a parallel tax code compared to the regular one. And typically it's used by people who have higher incomes and they're starting to deduct things. So for example, and this is for listeners, I'm not trying to educate Heather, she knows this. If you're investing in bonds in a taxable account and your income, you're in the 35 or 37% tax bracket, the income thrown off by those bonds is taxed at a 35 to 37% tax rate if you're hitting that marginal rate. If you then say, okay, I'm going to invest in municipal bonds where I can get away from any taxation of that. Sure, that's great on a regular tax code. AMT pulls all of that back in to your taxable bill, and it will start to tax it if you're starting to really take advantage of municipal bonds. And there's other things that get pulled back in.
When you start having clients in the 35, 37% tax bracket, we have some big things to think about this year. Like, should we be do we almost want to accelerate income into this year rather than next year? Like, it's going to get scenarios. Lots of scenarios. Yeah.
I mean, going back to your itemized deductions with the phase outs, a lot of people historically have been saying, well, I haven't had to worry about this. I just do the standard deduction. Like, I don't care about the itemized deductions being reduced. Well, SALT is being adjusted. So SALT is your state and local taxes and your real estate tax itemized deductions. So that was taken from whatever amount you could deduct. It was taken down to $10,000 as a limit. And so people living in those high income and high real estate tax states couldn't deduct much. Then the standard deduction went really high, and so they just stuck with the standard deduction. Well, now you're going back, and you've got a $40,000 limit for state and local income taxes and real estate taxes instead of that 10 if you're married filing jointly. So now the game changes on that too.
but income limited. Like if you make over, what is it, 500,000, anywhere between 500 and 600, you're starting to get limited down from your 40,000 max you can deduct. And once you earn over 600K, you're back down to your 10K max. That's all you get.
It was almost like the bait and switch. It was like, oh, SALT, we're going to adjust it. We're going from 10,000 to 40. Give us a round of applause. Only if you're under 500,000, because you're now not exempt at 40,000, you're down to 10.
And
it's like, oh, okay.
And I'm really curious because I feel like my high income earners are the ones that are being maxed out on SALT for sure, right? Like that's.
I mean, they have the bigger houses. They've got bigger income taxes.
Yes. And I'm even talking not even in the high tax rate, like, but even if you had someone making, I don't know, $300,000, $400,000, I still think they were getting limited on their SALT because property taxes alone in California, New York, I mean, even Texas, I think they're high. This goes through 2029. And then we go back in 2030, back to the 10 only. It's such weird. Again, planning. If you're going to have a high income year and you know next year you're going to be in, I don't know, 500 to 600 and you're going to be, but this year you're in 300,000, like, do you prepay your property taxes if you can?
I think this is a big Roth conversion conversation, because if you're starting to look to do Roth conversions, you have to be aware of the tax code changes if you're thinking about itemizing too. Because if you add income to your already existing income with a Roth conversion, you may then phase out on your itemized deductions. And then that means that you're paying even higher taxes than you would have done had you not done the Roth conversion. I was looking at some math people were running. So they were saying, okay, if you earn 500,000 and you did a Roth conversion of $100,000 to push you up to 600,000, and you were looking to itemize, that itemized bill went from 40,000, you phased out, now you're down to 10,000. You've increased your tax bill by $45,000, even though you've only increased your income by 100,000. So you've now pushed yourself from a 37% tax bracket to a 45% tax bracket on your extra $1,000 of income.
You know what's sad about some of this bill that I want to say is that why are some things only through 2028? If this is truly what's best for our country, why is it expiring? We need to be making tax law changes for what's best for the country. This when I'm reading this, I'm like, political play. Anyways, all right.
Great.
Charity rules. One of these actually made me a little sad. Single can take a $1,000 above the line deduction for charity contributions, and joint married filers can get a $2,000 charity deduction. So that's good. I mean, if you're not itemizing, you can now deduct, depending on if you're filing single or joint, $1,000 to $2,000 of charitable contributions. This part, though, do you want to talk about it? The floor?
All right. So if you're charitably minded and you make a donation to charity, you don't get the tax benefit of that. You're doing it out of the goodness of your own heart, because 0.5% of your adjusted gross income is a floor. So if you're making $200,000 a year and you make $1,000 donation, that's not deductible, because that is going up to 0.5% of your adjusted gross income. Anything above that, you can start to itemize.
Wait, what's 200 times? 0.5 is 1,000 of 1,000 is 0.5 of 200 income. I got it.
Thank you for qualifying my math there. Thanks.
Yeah, I had to follow you. If I wasn't following, then our listeners weren't following. So 0.5% of 200,000 income is $1,000. And so that means, like, if you only donated $1,000, you didn't even go over the floor. So but if you donated in that situation, in that income, and you donated, let's say, $1,500, then you get a $500 deduction.
I think if people are able to front load deductions in 2025, their charitable donations, I think that's the play, because now you're going to start to get nickel and dimed when you get into 2026.
Okay, last high income, high net worth problem. Estate exemptions are now locked in. The estate exemption is now locked in at $15 million per person. So unless like you and your spouse pass away and you have $29 million to pass down to your kids, there's no estate tax. 30 million basically for married, like crazy. So this has now become an ultra wealthy problem. Fine. There's loopholes, of course. But what I think a lot of people forget, though, is states. A lot of states have lower estate tax exemptions. So pay attention. I'm just going to name a few. There's more, but Washington, Rhode Island, Oregon, Minnesota, New York, Illinois. That's just to name a few. They have lower than this. So it doesn't mean that you still need to plan if you're in states that have lower estate tax exemptions than federal.
Agreed. This also goes to gift tax too. I believe they locked gift tax at 15 million. So that's your lifetime exemption. So if you want to give this away before you die and leave $15 million, you can do. It's the same limit.
Business owners. All right, business owners. If you're a business owner, keep listening. Big changes for you. Bonus depreciation is back. Oh, and if you have a rental property, that's a big deal too. Or if you're buying rental properties, bonus depreciation is back at 100%. It was 40 this year. It's now back to 100%. But here's what's funny, Dave. Do you know what date this is on this one?
I'm guessing it's different.
It's different, but it's a very exact date. I'm going to see if you catch on. It is 1/19/2025. This goes to 100%. So if you bought that 6,000 pound vehicle for your business on 1/14/2025, no, you don't get the 100% bonus. You get the 100% bonus after 1/19/2025. Do you know why?
I have no idea. That's bizarre.
It's when he was elected president. Can we talk about an ego?
Oh. Well, that was his inauguration day?
That's what I meant. Like,
that's so bizarre. You can retroactively January 1st everything else except this one.
It might be 1/18/2025. I got to go back to the exact date, but it is literally the exact date of, yeah, okay, moving on. 1099s. This actually excited me because I feel like this never got, like the minimum threshold never got boosted for inflation.
Yeah.
So in a business, you pay contractors, you have to file a 1099 if you pay anyone over $600, a contractor. They have now increased that to $2,000 per contractor, which I think I'm actually kind of happy about that. I feel like as a business owner, we have enough things, and $600 kind of started seeming like a lot of people could fall into that.
For sure.
Yeah. Oh, the standard deduction got increased this year, weirdly enough, by an extra $750 for individuals. Why I'm bringing this up under the business owner portion is I do have clients that pay their kids through their business because their kids work in the business, and this is how we get some income deduction for them, for my business owner clients, and then the kid gets non-taxable income if you pay them under the standard deduction, and then we can do Roth IRAs for them. So it's great. But why I'm bringing this up is I'm going to increase their payroll and be like, hey, we should probably give these kids a raise. Are they doing good? Because we just got a $750 bump in standard deduction. R&D expenses. I know you're like, Heather, what? But I actually have 2 clients that this hit. I just want to play this out for you. Businesses that were creating a software, any expense that they paid to create this product, payroll was the biggest one, had to be amortized over 5 years. I want you to think that you're a business, you're creating a product, you're paying someone $150,000 to create this product, and you can only deduct their salary 1/5 that year that you paid out. Can you imagine the tax bill for some of these clients that happened? It was huge. They could only deduct some of their business expenses over 5 years. I actually like this one. Now they can take all that unamortized expenses and deduct it all in 2025, or they can go back and retroactively deduct it. So the amortization thing is going away. Interestingly enough, with these clients, we're going to have to run scenarios because it's like, what year does it make the best bang for your buck to kind of deduct it in?
Yeah.
Like what you want to do it probably in the higher income years, right? So if you have clients or if you are a business with R&D tax credits and this starts sounding familiar, you need to get with your CPA ASAP. I think I looked into this because you can go back, I think, to 2022 or something and amend. But you only can amend back so far, right? In years. So we actually have a deadline to kind of make this decision. I think it was like next year. So we have time, but yeah. Mm-hmm. QBI is now permanent. That's that 20% business deduction on income. I think that's good because I was thinking if this expired in 2025, how it was supposed to, some business owners, business clients were going to get some huge tax bills next year. Like that was going to be a big, you're now taking a 20% deduction away from businesses. That would have been pretty huge. Mm-hmm. There are some more changes on like income limits and thresholds. I'm waiting for more guidance to come out because the way that it is written is just confusing as fluff. So sometimes I need to see the forms and how it applies. So we'll talk about that later. But the good news is that it's now permanent, but there are some changes with QBI. So we did it.
We made it. You made it, viewers and listeners. You made it.
Do we want... Can our listeners hear through these questions we have right now and our answers? Do we do it?
Do we do it? Of course we do.
Okay,
let's do it. Of course we do. People can turn off if they want to. Let me give you an incentive. If you listen to the next episode of this on the same day, email us at hello@playbookotw.com and I'll send you some free merch. All right, we're going into our next segment. It is called What Would You Do? All right, this is the question section. We've made questions based on this information that we just went through, just to make it easier to understand if you got confused along the way. So, first question. My son was born in February 2025, and I want to start saving for his education costs. Should I be saving to his Trump savings account, a 529 plan, or both? What do you think, Heath?
Well, I mean, you're already going to get $1,000 in the Trump plan. Trump count, whatever the thing is called. So you're already going to get $1,000 from the government because your kid was born in February 2025. I would still probably prioritize 529. I need more guidance on if I'm excited about these. So, and you can't even contribute until 2026. So I don't know your income. If you have high income, you want to start the compounding, what is the gift limit this year? 19, I think. 19,000, throw 19,000 in a 529, get that going. And then if the Trump savings accounts seem to be a good idea, then you can also do that, but not until next year. So for this year, take the one from the government and throw 19 in the 529. That's what I would do for now.
I like it.
All right. My wife and I are looking to replace her car and are looking at electric vehicle options. How do we time this correctly with the expiring energy credits? Oh, this was perfect for you to answer.
It's almost like I wrote it. Mm-hmm. If you're looking to buy an electric car or an EV, you have until September 30th, 2025 to take possession of the vehicle. If you're looking to get a charger for your house, you have until the middle of 2026. So 2 different options in terms of timing that will complete your purchase, because don't charge it on the mobile charger. That's stupid.
Just do both before the September 30th for ease. So that's my.
So you got to get on your bike here, sir. You got to do this quickly. Take possession by September 30th, 2025.
You got to get on your bike.
British phrase coming out. Look out.
I've never even heard that.
All right. Number 3. My income is generated by collecting receivable invoices. So we've got a business owner here. I'm predicting a high income year of around 750,000, but it will go lower next year near 250,000. I have a lot of itemized deductions each year. What will be the best way to design this income to manage my taxes? I think your key thing here is your itemized deduction phase out limit of 500,000. But if your income is around 750,000 this year, there's a chance you're not going to be able to itemize everything because you're going to hit some phase outs. If you can push 250,000 of that into next year, so you've got 500,000 this year and 500,000 next year, and your itemized deductions are still high in both years, that's going to give you the most bang for your buck. Caveat is, please do some tax planning beforehand.
Yeah.
We're going into highlights. All right, we are going into highlights. Highlights is a section where we talk about our personal wins. If you're here this far in the podcast, congratulations. You get to hear some fun stuff. I am going to go first because I bought an EV. So I got a Tesla. This is a whole story.
Wait, listeners, did you not catch on the whole time of why Dave kept saying EV and was so excited about EV? And by the way, when the tax law passed and
Are you taking my story away?
I'm not taking the story away. I'm telling how funny you are, is that you told me that before you even got through studying the tax bill, you were already buying this car.
The bill wasn't even signed yet.
Yeah. Yeah, that's hysterical.
As soon as the Senate passed it and it got on Trump's desk, I hit purchase. I'm like, I'm not waiting. As soon as that September 30th came out, my original goal was to purchase it 6 months from September 30th, like in March, when my son is going to take my car and start driving. So that got completely accelerated. And then I was like, okay, if I order it now, hopefully I get it by September 30th and I can like still get the credit. Tesla then emailed and said, can you come next Thursday? I'm like, I'm sorry, what? 5 days from now to pick up the customized car? I didn't even get one off the lot. So that in the back of my mind, I'm like, how many Teslas are sitting around just not being purchased? But I didn't care. So then I took it to my son's baseball game. He was so excited to see it.
Wait, you have it now. You have it.
Oh, I have it. Yeah.
I didn't know this part. Do you love it?
Yes. So I used a friend's coupon code who has a Tesla. So that then gets you a benefit. It got me 3 months of full self-driving, which is where you can hit, here's the address I want you to drive to, press the button, and it's going to take me there, as long as I don't fall asleep, because then it pulls you over. I test drove that on the way back from a baseball game on the first day of owning it, through a thunderstorm, through construction. I was like, if this is going to fail, it's going to fail in a mighty way. And it took me all the way home. So I'm driving everywhere I can and making up excuses to drive everywhere I can. It's great.
You love it. I'm happy for you. I'm curious, I know where you stand. We're very middle of the road, but I'm curious how, if anyone treats you differently with like having a Tesla. Because I will say, oh boy, I'm going to out myself for this and I'm still embarrassed by it. But there was a point in my life where I had a Maserati. And I will tell you that I have never been so judged in my life by what I drove.
Mm-hmm. Oh yeah. I've had some looks. People are like, you bought a Tesla? I'm like, it's a car.
Yeah. Okay.
Relax.
Oh yeah.
All right.
Well, I'm so happy for you that you treated yourself. This was on your goal list for a long time. Well, mine is not as exciting. I did not buy a car. I think we met some friends up in like Deer Valley, Park City, which it's kind of hard to make friends when you're here for only a month or two out of the year. We don't have a residence, we rent. But weirdly enough, our neighbors have friends that come up here every summer too, and they have kids around my kids' age, and we're going to dinner with them tonight, and I've already seen them twice in the last week.
That's awesome.
I know. And she's a business owner.
Oh, she's your twin.
Guess what? She's really cool. Guess what she does?
She sells artisanal candles.
No, she's
made of goat's fat.
No, she's an art dealer.
Oh, that's fun.
Uh-huh. And she just sold 2 Warhols. I'm like, hello.
Wow.
I know. I'm excited. So that's my win. I'm just very excited.
Awesome. Jordan, go.
All opinions expressed by Dave Grant and Heather Townsend are solely their own opinions and do not reflect the views of their respective wealth management firms. This podcast is for informational purposes only and should not be relied upon for investment decisions. Nothing in this material constitutes a solicitation for the sale or purchase of any securities. Clients of Retirement Matters and Townsend Financial may maintain positions in the securities discussed in this podcast.
Thank you, sir. That was great. That was so fast. All right. Thank you for listening to this episode of Playbook of the Wealthy. You can find us on whichever platform you listen to podcasts. You can also watch the video on YouTube, LinkedIn, Instagram, and anywhere else that does video. If you want to send us an email to the show, you can contact us at hello@playbookotw.com. And we'll see you next time.
Toodles!